So it's a very diverse asset class. So 25 countries, there's always a range of different outcomes. And that means that the performance across markets varies significantly. But that dynamic, if anything, has been stronger this year than in a typical year. And the real most obvious difference is the underperformance of Chinese equities. So when China opened up, moved away from COVID zero late last year, there was some optimism that the Chinese economy was turning a corner, that we were going to open up. It would be a better place for investors. And that really hasn't worked out. The other side of that coin is the strong outperformance of Mexico. So if you think of all the issues that face China from a geopolitical perspective, China is probably the only issue for which there's bipartisan support in the US, for a tougher stance on China. Mexico is the opposite of that. So that structural deterioration in US-China relations absolutely plays into Mexico's hands. So we've seen strong outperformance of Mexico, and we think that's the beginning of a multi-year period. The strategy is very well positioned for that. Mexico is our biggest overweight market, but we think we've really just seen the tip of the iceberg there in a decoupling of US and China and a nearshoring. So manufacturing coming back to North America, classic example of that. The Inflation Reduction Act, the IRA, provides tax breaks for companies in North America, not just the US. And Mexico benefits from the same tax breaks as the US does. So we're at a very interesting spot at the moment. If you think of the way that developed market central banks have run monetary policy, really since the GFC, it's been unorthodox monetary policy. So it's a combination of quantitative easing and zero interest rate policy, effectively money printing. And meanwhile, emerging market central banks have maintained very orthodox monetary policy, positive real rates. And so that's created a tailwind for developed market assets that emerging market assets haven't had, really since the GFC, exasperated by the reaction to the pandemic, which was again back to money printing. We're at a very interesting juncture currently because for the first time in more than a decade, developed markets are having to move back to orthodox monetary policy because of inflation. Even in places such as Japan, it's really had zero interest rate policy for more than 2 decades. You're seeing a move towards normalization. And so that means that tailwind that developed market equities have had, that's being removed and it's going to turn into a headwind. Now, the flip side of that is emerging markets that have run orthodox monetary policy, relatively high rates, and that's because of the history of inflation. Central bankers in emerging markets tend to be more hawkish. That's the bias because of the history of inflation shocks in emerging markets. They're moving to actually cut rates. So you're seeing a differential open up. And so we think there's some signs that the US dollar probably peaked in September last year. We're long overdue a downtrend in the US dollar. On average, US dollars moved in 8-year cycles. If indeed the US dollar did peak in September last year, we move into a weaker US dollar period, every time in history we've seen a weak US dollar, it's coincided with very, very strong EM outperformance. So it's a very good setting, we think, for the asset class. And on top of that, we have cheap equities. EM equities, when we compare like for like to developed markets, are trading on a discount. Example for the strategy, our biggest overweight market is Mexico. Very well positioned with this deterioration in US-China relations, excellent demographics, benefiting from nearshoring and manufacturing, and yet the Mexican market's trading on about 12.5 times forward earnings. So you've got this wonderful opportunity, it's just not reflected in equity valuations yet. So I think if we take a longer term view, the outlook is pretty clear. Valuation support is very strong. Emerging market equities are trading at a big discount to developed markets. Now that's particularly the case for high quality companies. So if you divide the EM index into 5 buckets, quintiles by quality, and here we're talking about return on assets, return on invested capital, the highest returning companies have never been cheaper relative to the broader benchmark. So you're getting quality companies at a discount you've never seen in the history. So that all bodes very well on a medium to long-term view. So really the risks are in the short term. And here it's geopolitical. So emerging market equities look cheap. The US dollar looked overvalued heading into Russia's invasion of Ukraine. But that geopolitical shock resulted in a flight to safety. US dollar had another rally, and it was a tough time for emerging market equities. So there are always geopolitical icebergs out, but I think for investors that can take a longer year view, 12, 18 plus months, then the outlook is very strong. So I think we see the resurgence of quality. We've had a brief period where value is outperformed in emerging markets, lower quality, cheaper stocks. I think we're going to have a return to a market differentiating companies by quality. And so I see strong outperformance for companies like Bank Central Asia in Indonesia. This is the leading bank in the country. Remember, Indonesia, vast economy, more than 200 million people. Less than 50% of people in Indonesia have a bank account. So it's like investing in Commonwealth Bank 80 years ago. So you're entering a financial system at a very, very low level of financial penetration. In a country like Australia, mortgage debt to GDP is about 130%. In Indonesia, it's single digit. So you've got this multi-year tailwind of double-digit loan growth. And that bank is probably the most profitable bank in the world. It earns a 3% ROA, which is unheard of in developed markets. Very well run. The competitors are state-owned enterprises. See a similar dynamic in India with HDFC. Again, very underpenetrated credit market. Their main loan product for HDFC Group is mortgages. You're seeing private home ownership expand, people getting a mortgage for the first time. Beautiful demographics. Most of the population in both those countries is below the age of 30. And so these kind of long-tailed, high-quality companies, I think, again, rise to the surface in the second half. And I think, we've been, as a market, focused on very short-term issues. What's Powell going to do with the rates? What's going on in Ukraine and so on? I think actually the market's going to start distinguishing long-term quality again, leading to an outperformance of those types of businesses.